Hello and welcome to this weekly market recap for the week ending Wednesday, November 19th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It is a pleasure to be with all of you again this week. A lot of selling has taken place, though, since the last time we spoke. So we're going to take a look at some key support levels and resistance levels to watch as we go forward on all of our key indices. Take a look at the rotation that's taken place in many of the sectors. Many of those AI stocks have really hurt the growth names, the growth sector or growth area of the market. And we're seeing some of that money rotate in some other key areas of the market like energy and healthcare and so forth. We're going to get into all of that. So let's go ahead and take a look at what happened last week on our major indices. S&P 500 was actually our best performing index. It only lost 3%. Nasdaq 100 down 3.44%. S&P 400 mid-cap down almost 3.5%. Transports down almost 4%. And then both the Russell 2000 and the Dow Jones both falling more than 4%, with the Dow down almost 4.4% for the week. So it was a really rough week for equities. I want to go through and show you what those charts look like. So Dow Jones, we did lose the 50-day moving average. A lot of folks get upset when we lose the 50-day moving average. I'm not one of them. I believe price support is much, much more important than the 50-day moving average. A lot of times when you're going up rapidly, that 50-day moving average goes up rapidly, and you will pull back below the 50-day. So I don't really pay nearly as much attention to that 50-day moving average, although it is something, on individual stocks, it does trigger some selling and so forth. So it is something to keep an eye on. But again, to me, the biggest number is the key support. If you look at the Dow Jones, you'll see multiple tops coming across here at about that 45,000 level before we broke out. We've got a measurement now up to 53,000. I think as long as we stay above 45,000 where we broke out from, I think we're fine. So it's been a rough week or so across most of the most areas of the market, but you can see the Dow Jones still comfortably above that 45,000 level. S&P 500, recent low. I'm kind of watching initially about the 65.50 area, which was the low that we saw on Friday, October 10th. That was the big red filled candle. We saw a lot of selling that day. And since then, we picked it up, went right back up to new highs. So can we hold that level on the way down? If we do, I think we're in good shape. If we don't, then that's going to open the door to some more selling. Nasdaq 100, pretty much the same thing. The breakout above the second week of August or mid-August high was at about 24,000. So I'm kind of watching that to the downside. So far, we're holding that level. S&P 400 mid-cap seen a little bit more damage technically. We did lose that low from October 10th. So I think that could set up a little bit more selling. I've got another key level of support coming in at about 3,100, which only leaves maybe another 2% or so to the downside on the S&P 400 mid-cap. Small cap, this is where things start to get a little bit more dicey. I was a fan of the small caps. I was looking for relative strength, and that was when I was expecting the Fed to cut interest rates in December and perhaps a couple more times in 2026. It is starting to look like, based on the way the market is trading, like we're not going to see that rate cut in December. That's what I'm anticipating at this point. And one of the reasons I say that is because we had a head and shoulder top and breakdown on the IWM. We have been seeing relative weakness here, and I'll show you that in just a minute. But the IWM small cap stocks have been showing relative weakness now for close to a month. And that normally would not happen if you're looking for lower rates ahead. So the head and shoulder breakdown, in my opinion, measures down to about 224, 225. And that's where a pretty key area of support comes in. Prior to that, we did reverse on Tuesday at about 231, which is another level where I see some short-term support. So that's what I would watch to the downside, 231, and then down to about 224, 225. To the upside, we've now got neckline resistance at 238, and we've got a declining 20-day moving average. You can see with that red arrow, coming in right at about the 240 level. So I think the IWM is kind of trapped in this trading range. We'll see which level, which area breaks first. My guess is we're going to hold that 224, and ultimately we're going to break back to the upside. But if the market starts getting wind that, we might delay cutting rates for many months, I think we could see not only the 224 level, but maybe we go below that. So I think that's going to be an interesting signal for us to watch in the days and weeks ahead. And then transportation stocks failed for the third time up at 16.5, pulled back, could not hold that rising 20-day moving average. So this no longer looks like an uptrend to me. It simply looks like more consolidation, which is what we've been seeing for about the last 5 months now. Highs at 16.5, lows at about 15.1. That's your trading range on the transports. We closed almost right in the middle of that, near 15.750. All right, moving on to the sectors. So down at the bottom, you'll see many of the aggressive groups that took it on the chin the most. Consumer discretionary last week dropping 5.6%. Technology 4.4%. Financials 3.9%. This is the reason why we saw the major indices getting hit so hard, because these are three big areas of the market. If you look at the percentage representation, technology is 36% of the S&P 500. And if you throw in financials and consumer discretionary, you're well over 50% of the S&P 500. So if you've got more than 50% of the S&P 500 dropping to this degree, even if we're seeing some relative strength in some other areas, still not going to be enough to right the ship. Now, many of you may point out that, hey, Tom, technology, consumer discretionary, these areas are performing poorly. Doesn't that mean that we've got more weakness ahead? Not when the market's coming down. That's what I expect when the market's coming down. I expect the aggressive groups to sell off more because we made more on the way up in those areas. So you're going to see a little bit more profit taking in areas where there are more profits. What we want to be careful of and what we're going to want to watch is that eventually when we do rally back, which we will, where does the money rotate on that move back to the upside? Now, if we're moving back up and we're still looking at these groups down at the bottom as the market tries to rally, that to me is a feeble rally attempt, which likely will fail. So that's something that we definitely want to kind of keep an eye on as we go forward. If I stretch this out to the last month, look at healthcare and energy, the only two sectors leading. Healthcare gaining more than 6% over the last month. If you're looking for momentum, you don't have to look much further than healthcare. That's where we are seeing a lot of money rotating. But let's keep rolling, take a look. I wanted to point out the rotation that's been taking place over the course of the last month, month and a half. Here's middle of October. You can see that the IWM small caps relative to the S&P 500 large caps, small caps were going up. This was in anticipation of the rate cut, which we ended up getting in the latter part of October. But just prior to getting that rate cut, the small caps topped on a relative basis versus the large cap S&P 500. And we have been downtrending ever since. This wasn't just a little bit of profit taking, buy on rumor, sell on the news, and then get ready to move up again. This has just been going straight down now for about 5 weeks. If you look down at the second panel, this is large cap growth versus large cap value. Again, when rates are being cut, those lower rates increase the value of companies that can produce higher growth rates down the road. Because if you take lower interest rates to discount future cash flows, you're going to have higher valuations. So when the rates are no longer expected to be cut, that's kind of like a rate hike to some degree. And that's going to start to hurt those valuations of growth companies. And look at what happened. Literally on the day of the last rate cut, that's when we topped in large cap growth versus large cap value. And that's been downtrending ever since. Then you go down to the bottom panel and you've got consumer discretionary versus consumer staples. If the market was anticipating more rate cuts, that would benefit consumer discretionary stocks down the road as the economy strengthens. Well, again, right after the last rate cut, this group topped, and we've just moved down to about a 3-month low on discretionary versus staples. So again, all of these things are suggesting to me that we're not going to get that rate cut in December. I'll be really surprised. And if it looks like we're going to as we get closer to that meeting, watch these three ratios, because I think they will take back off to the upside if the market starts to feel that rate cuts are more likely. But based on what I'm seeing right now, I just don't think that's going to be the case. All right, one area that is benefiting, I just pointed out that over the last month, healthcare has gone up 6%. Look at the XLV. The top panel here is the absolute price chart. So you can see the XLV coming off of a triple bottom down around 128 is now trending higher and has easily moved to a new 52-week high. So very, very strong area of the market. We're in a bull flag. We just had a huge move to the upside, seeing even when the market pulled back the last 5 days. Look at this group. It was the best performing group over the last week, barely down at all. And it looks to me like it's ready to make another big breakout to the upside. The bottom panel here shows relative strength. This is the XLV relative to the S&P 500. We had been downtrending. We put in a double relative bottom in August and September, and now we're uptrending, and we just hit about a 6-month relative high in the XLV in healthcare relative to the S&P. So there's no doubt where this money is rotating to and the area of the market that's carrying the most momentum right now. First, I want to go over Nvidia. Nvidia reported earnings after the bell today. Been waiting for this one. The stock right now is up a little over 5% after hours. That's good. It's in a trading range, so I don't think we're ready to just blow away the recent high. But keep in mind how much Nvidia has gained over the course of the last 7 months or so. Coming off of that April low, we got all the way up to 210. To the downside, the recent low was about 165. I think that's our trading range for a while in Nvidia, which is okay. It's okay to take a break for a period of time after you've had such a huge move to the upside. I think the fundamentals have to catch up with some of the technicals. So Nvidia gapping up into the mid 190s after hours. I could see it maybe running back up to test this 210 level at some point. Can we break out? We can. I don't think we will, but we could. Instead, I think what's going to happen is we're going to see more and more of this sideways consolidation, not just in Nvidia, but probably from the majority of the semiconductor companies, which have had such a huge run off that April low. All right, if you're new to Earnings Beats, I just want to point you to our homepage, earningsbeats.com. We have a free, no-cost 30-day trial. That green button right there, you can get started there. We also have a free newsletter. No credit card required on our free newsletter. Name, email, address is all it takes. That comes out Monday and Wednesday. I do want to mention now through December 1st, we have started our fall special. A great deal. You can save a couple $100s on an annual membership, which saves about 60% off of a regular monthly membership if you had that for a year. But this fall special includes 2 months free. So not only are you getting a couple $100s off the annual membership, but you're going to get 14 months instead of 12. So if you click on this fall special link, it'll bring you to this page right here. You also, in the description of today's video, you'll see a link. And in that link, it'll take you to this page where you can then sign up and claim your offer. Again, you've got until December 1st. I'll be mentioning it over the next couple weeks, but don't miss out. This is the best deal we offer all year. Included in this special, by the way, as an annual member, you can come to our Market Vision 2026 event for free. That is normally a $600-700 value on its own. Annual members at Earnings Beats get to come to that event for free. That's where I lay out my prediction for the whole year. I've been pretty spot on for the last 6 years. This will be the 7th one we're about to do, first weekend of January 2026. And the key by signing up for this special is that you get 14 months. Those 14 months take you all the way into January of 2027. So this is actually getting you 2 Market Vision events, each with a value of $600 or $700. So the deal isn't going to get any better than this. Definitely check this out. If you've been thinking about coming on board, now is the time to do it. Take advantage of our fall special. All right, want to move on. Got a couple charts, a few charts to go over. I just want to point out what I'm doing is going into under member tools. If you scroll down, you will see the scooter reports. That's where I'm going to. Here, when you click on that report, it brings up as a default large cap stocks, and they'll be in scooter order. I have changed the time frame to a week, which doesn't change the scooter. Scooter is still the same, but what it does change is the change in the scooter score over the course of the last week. If you click on this column, it'll tell you which one has gone up the most. Scooter, SCTR, is just an acronym for Stockcharts Technical Rank. So it's a relative strength system. You can get a really good idea of some stocks that are showing a lot of improvement in their relative strength just by going to this report. So having said all this, I'm going to start and give you a couple names in the mid-cap space. So CRNX. I think this is a stock that is consolidating after this big breakout. Even as it consolidates, that AD line has been strengthening. I think there's accumulation taking place. Watch for a breakout above 56. NUVL, another mid cap. Look at that AD line breaking out, price just breaking out. Another one I think looks really strong here. INDV. Now, on this daily chart, it's just breaking out to new highs. It's been a great performer. I'm going to show you, though, a longer-term chart in just a minute. But look at that AD line. Relative strength, been moving up. Great volume trends. Let me pull up that longer-term monthly chart because we have not had I'm not sure what the exact daily close is, the high daily close, but it was back in 2018, and I believe it was about, I want to say 33.58. Double check me on that. We closed today at 32.60. We are getting very close to that level. I think if we break out, especially with the kind of momentum and volume that's been coming in, I think you're going to see a lot of traders jumping on this. As far as some of the large cap names go, I want to go over some of these that I think have really strengthened. And remember, I'm not a value trader. I'm a momentum trader. So I'm not looking for stocks that are down near lows. I'm looking for stocks that are right now making money because I think many of them continue to go higher. Medtronic just gapped up, broke out above its early October high. I think this one looks good. Then you've got Pod, which is Insulet Corp. I think this is a nice little cup forming. Might see a little pause just above 350, and then I think it resumes and breaks out. Johnson & Johnson, defensive name, but hey, I'm not arguing with making money. Johnson & Johnson, big breakout. Look at all of these hollow candles. AD line is soaring. Any kind of a pullback to the 20-day moving average makes sense there. Amgen, if you look at a long-term chart on Amgen, it just broke above 330 for the first time, 330, 335. I think this one continues to go higher. Steris, this is one of my favorite companies. If you followed our fantasy draft on Saturday, I did that with Julius and Grayson. This was one of my stocks I really liked. This is the one I picked out of the healthcare sector. Love this pullback testing the 20-day moving average. Lilly, another great stock. This thing is absolutely on fire. And I know it's overbought, but these stocks, especially Lilly, it's one of the few pharmas that when it gets going, it can really get going. I like this one to continue going higher. Cardinal Health, after its solid earnings at the end of October, gapped up, broke out, and I think continues to push to the upside. Love this one. IDXX gapped up with earnings, pulled back into the gap support zone, started to turn back around again on Wednesday. I see this one breaking out and going higher. Guardant Health, a little bit riskier, but I'll tell you what, this one looks real good to me. I love all these hollow candles. Again, it's very, very strong AD line. Pullback, I think, warrants consideration, especially as a riskier type of trader. INSM, this is one of the strongest scooter scores in the healthcare area, and it's easy to see why. This thing just keeps going higher and higher. MedPace, MEDP, big gap up with earnings. Great earnings came out. It's pulled back. It's testing its 20-day. I think this one goes back up and breaks out again. And that is the list I have for you. So that's it for today. Be careful in some of the technology names, especially if we can't get a breakout with Nvidia and it just starts to drift back down again and semiconductors struggle. Watch these healthcare stocks because this is where the money's rotating along with energy. Energy's been seeing strength as well. So those are a couple key areas to keep a really close eye on. I'll be back next week and we'll check it out all again, over again. Until then, have a great week and I will see you next week. Happy trading, everybody.